this is Shelby with Lusk Mortgage Group. Welcome back to week 5 of our first-time homebuyers course online, 120 days homeschooled edition. So this week we're talking about credit a little bit more so, just because it's such an important part of the home buying process and to understand how that really affects everything throughout the mortgage process. So for instance, when we're looking at credit scores, there's a lot of things that really are factored into that score, but how that credit score affects your interest rate, there's a lot that goes into that as well. So every set of interest rates that you're looking at are going to have different adjustments based on what the credit score is. So let's say if you're above a 760, there might not be any adjustments for a particular rate. Well, that same rate might have a decent adjustment if we're at a 620 credit score. And we talked about that a few episodes prior ago. I believe it was the first episode. We talked about, what a par rate is and how those adjustments kind of come into place. But going back to credit here, when we're looking at, a 700 credit score, for instance, well, that particular client might be eligible for a par rate of 4.25, let's say. Well, if that person had the exact same scenario, but a 620 credit score, well, they might be looking at a 4.875% interest rate in place of that, just to show you a little bit of variable as to how that really affects your mortgage long term. Now, what actually goes into your credit, right? There's a number of things that determine what your credit score is. For instance, what's going to be reported on your credit report is going to be any auto loans you've ever had, home loans, any revolving accounts or lines of credits that you have applied for and are currently using. In addition to that, they are going to show us any court records or liens that you might have on your from your taxes that are now reporting to the bureaus. Any collections that you might be receiving letters for might show up on your credit report as well. Anybody that's pulled credit for you for the last 120 days is also going to show up on your credit report. So there's a lot of great information that you'll find on your credit report once you're at that stage where you're ready to apply for a loan. And that's something your loan officer can help you out with in going through what all's reporting there. Now, when we are talking about credit, I know that right now you're thinking, okay, well, what can I do to better my scores? There's a few things I want to make sure that you don't do, because those are some common misconceptions and some things that happen that I want to help you out and avoid doing right now. So a lot of people think, well, I don't have any revolving credit, so I should go and apply for a credit card. Before you do that, let's talk to a credit professional or talk to a loan officer about how that might affect your particular situation. Because believe it or not, sometimes having no credit at all is better than having little credit. So feel free to private message us about that. I'd be glad to explain that further for you. Now, some other things, we might have a card for Nebraska Furniture Mart already, and you're getting excited about purchasing, so you went ahead to reserve that new sofa. Well, in doing that, we might have created a debt to income problem, right? When we're looking at debt to income, for instance, when you go to purchase a home, we're looking at your overall debt versus your overall income. So how that's calculated is if you make X amount a month, right, and you have X amount of debt on a monthly basis, well, what we're going to do is divide those two numbers to come up with your top debt to income ratio number, okay? There's two numbers that a bank uses. We use a top and we use a bottom. That top is just your monthly income divided by the debt that you have reported on your credit report, okay? Now that bottom number is going to be your income again, and then divided by all of your debt that's reporting on your credit report plus the new mortgage you're applying for, and then that's divided, and that gives us that other number. So that's a huge factor of what you're going to be pre-approved for, as well as that debt to income ratio. Okay, now going back to what we were talking about, some different things to not do when you're worried about your credit and different things like that, is again going back and applying for a new credit card or adding a balance to that Nebraska Furniture Mart card to reserve that new sofa. That's going to fluctuate some different things with your credit, and you want to make sure you talk to somebody before you go out and you do those kinds of things. Also, try not to be late on your credit report. That's going to be a huge problem for a lot of banks, unfortunately. If you have had a late in the last 12 months that's reporting on your credit report, there are a lot of people that are going to tell you, I'm sorry, I'm not able to help you right now. It's just a general kind of standard that if we see a 12-month late, we've got to wait until the 12 months later where we don't have any lates reflected. So making sure that you're making those payments on time is going to be a huge factor in continuing to improve your credit score. So as a fun example for you here, just for the do's and don'ts. I guess it's not so much fun, but it's just a reality of what really can happen. Once you get into the loan process, and doing that now and doing it, when you actually apply, there's some differences here. For instance, you might go and apply for an auto loan today, right? Well, your first payment might not be due for a month or two. Well, if you haven't told the loan officer you're working with about that auto loan you just applied for, that might hinder the entire loan process for you altogether because it hasn't reported to credit yet. Well, before we close on the home loan, we make sure that the credit is still what it was at the beginning of the application. Back to that not so funny story. I unfortunately had a gentleman that we were working with quite a number of years ago who had gone out and purchased a new auto loan, right? He had actually gone out and got himself a brand new Shelbi Mustang. It was an awesome looking car. The problem was that no one else knew that he had purchased that car until we went to closing that day. We pulled credit again to make sure everything was still the same as it was. Well, when we added that new obligation that he had applied for and already purchased, he no longer qualified for the home. So in that circumstance, that family unfortunately had a brand new car, but they did not have anywhere to live. So I'm sure we all know how that turned out for him. But that's just, reality of the situation is to communicate with your loan officer about your credit situation, to communicate with your credit professionals about what you're doing outside of what's reporting on your credit report right now, to make sure everything lines up appropriately. Because if there's an outstanding obligation that we just don't know about, I promise at some point in time it will show up. And so it's better to talk about it now than at the closing table when things go awry because we've just found out that you went and purchased a new auto. So feel free again to message us if you have any questions. We'd be happy to get back to you then. See you next time.